Hey guys, what's up? Spenny here. So not my usual video setup today. I'm actually out of town for the next few weeks. So I decided to download Zoom and now I'm in the New York Stock Exchange. But I'm still gonna be putting out videos for you guys. And today I have a really good one. I found an article by Seeking Alpha and they're providing us their top 5 picks from ARK Invest. And ARK Invest is, they have several different ETFs. So there's 5 ETFs run by ARK Invest. And then there's 2 international ones that aren't actively traded. But anyways, ARK Invest is led by Cathie Wood, and she's very famous for picking Bitcoin back in 2013, Tesla in 2018. She's picked Square, a number of very disruptive companies she's picked, and all these companies have been performing amazingly. So ARK Invest has gotten a lot of attention, and it used to be just by retail investors, but now we're actually starting to see institutions take Cathie Wood really seriously. So let's see what Seeking Alpha has to say about Cathie Wood and her fund. I'm going to skip a lot of it. I want to show you guys the 5 picks, and then I'm going to show you guys what picks out of these 5 that are my favorite, and I'm actually going to initiate a position in one of these starting Monday. So make sure you stay tuned till the end, and I'll let you guys know what pick that's going to be. Okay, guys, so their top 5 picks, I'm going to go through the list right away with you. First one is MercadoLibre. Second one is Teledoc Health. Third one is Twilio. Fourth one is Splunk. And the fifth one is the Trade Desk. But I don't want to cover all of these. I actually want to focus on the ones that I actually see really good opportunity in, because a couple of these are actually struggling quite a bit, and I don't really want to waste your guys' time with that. So the first one I want to cover, and this is actually the one that really has me interested in. I think I'm going to pull the trigger Monday and put a bunch of money into this company. MercadoLibre. So this is ticker MELI. This is basically the Amazon of South America. Massive e-commerce company that just entered the payment space as well. Everything is growing at a fast rate, and they're not a massive company yet. I mean, don't get me wrong, they're big, but not compared to their potential. Now, MercadoLibre is still just a drop in the bucket of what it could be. They have a market cap of 79 billion. If you compare that to Amazon, Amazon is well over $1 trillion. Alibaba is well over 700 billion. So I see no reason why this company can't 5 to 10x in the future. They're the dominant player for e-commerce in South America. And if we look at their chart, I mean, don't get me wrong, they have appreciated a lot. Back in March, they were about 450 a share at the bottom. Now we're 589. So they've more than tripled since the March low. But if we actually look at their financials, they're not overvalued. If we look at the price to sales ratio, their current price to sales ratio is 23. And this isn't bad considering at the rate they're growing. If we go over to what analysts are saying, analysts are expecting the year 2021 for this company to grow at 36%. And what I learned by reading several different Peter Lynch books, now what I'm about to say is dependent on the company's margins and several other factors. But for example, a quick look at this, if a company is growing at, let's say, 36%, then you could justify a 36 price to sales ratio. So when I see this being an obvious dominant leader in e-commerce, a massive growing total addressable market over the next 10 to 30 years, let's say, and they're trading at less than a 36 price to sales ratio, I like that. And this company doesn't have risk as well. I mean, of course, every equity has risk, but this is the leader, and I really don't see much risk at today's valuation, to be honest. Of course, you could have short-term downside. It has ran almost 300%, so anything could happen. But anyways, I actually really like MercadoLibre, and Monday morning, I'm going to be initiating a position. If I don't do that, I'll let you guys know, but I do plan on doing about a 3% position just to get some exposure in the space. The next company, though, I want to talk about, another really interesting one, and actually one that I think is just really going to perform amazing over the next 10 years, is the Trade Desk. This company has an amazing business model, and it's so important in today's age. What they do, so the Trade Desk is a global technology company that markets a software platform used by digital ad buyers to purchase data-driven advertising campaigns across various ad formats and devices. Now, this is important for almost all companies to use a software like this, and that is why the Trade Desk has huge customers. Basically, all of the big boys are using the Trade Desk. Ads is really important in today's age, and I can see this be important over the next 10, 20, 30 years. I mean, I think advertising has always been around, and now that the internet exists, it's the ultimate way to advertise. And right now, the Trade Desk is the best player in that industry. And their share price has appreciated with the appreciation of them being such a good company at what they do. If we look back in 2017, they were only $50 a share. Now we're trading above 900, but I think there's actually still a very good buying opportunity here. Because you gotta understand, if you were buying this stock of $50 a share, you were taking a huge risk. You did not know if this company was gonna be successful, but now they've proven themselves to be the leader in this. So you're taking that risk out, and that's why you're paying a lot more now. Doesn't mean they're overvalued though. Their market cap is 43 billion. I think this has a long ways to grow. I think you'd definitely 10x your money over the next 10 years. I have no doubt about that. And if we just take a quick look at their financials, they are trading at a premium. They have a price of sales of 59, where just a year ago it was 15. So don't get me wrong, that is expensive, but let's see what they're expected to grow at. So next year, analysts have them growing at 33%. I think this is going to be way higher. You see, if they actually do only grow at 33%, then I think they might be a little bit overvalued. Like I was saying earlier with MercadoLibre, you don't really want the price to sales ratio being much more than the rate they're growing. So in the Trade Desk case, I would like to see their price to sales ratio closer to 30 to 40, but I think analysts have this wrong. And it wouldn't be a surprise. If you look at their earnings history, analysts have been repeatedly wrong by 114%, 441%, and 195%. So I think they have this wrong. I think right now is still a good buying opportunity. Analysts do have the average price of 707 a share now, down from 917. And so that would make sense if they are only expecting them to grow about 33%. That makes sense to me. But the way this all changes is if they can pull off a growth rate of about 50%, then they are completely priced where they should be. So it just depends on how much you trust analysts. Personally, I don't trust them too much. They get these growth stocks wrong all the time. Just think Tesla, for example. They got that one obviously very wrong, and I think they have the Trade Desk wrong as well. But anyways, guys, I don't want to go too in depth on these stocks. I just want to show you guys what stocks I think are great buys. And I think MercadoLibre and Trade Desk are both really good buys, but I wouldn't be surprised to see some short-term downward pressure. Both of these stocks need to perform well. Any kind of weakness in their earnings reports, you're gonna see that downward pressure. And also just the market overall has been very generous to tech stocks. So we could see a correction in tech stocks anyways. So keep that in mind. If you're going to initiate a position in either one of these companies, you might have a short-term pullback within the next 2 months. But these are definitely worth to put on your watch list at the very least. And then there's just one other company I want to cover, and that's Teledoc Health. Teledoc Health is a multinational telemedicine and virtual healthcare company based in the United States. Primary services include telehealth, medical opinions, AI, and analytics. This is a huge growing market that is going to become so important over the next 10 years, especially in today's day and age with the stay-at-home environment. But regardless, I think people are figuring out ways to not go to that doctor so often anymore. We can do it from home, and Teledoc is the leader in that market. So I think they're a great buying opportunity as well. But again, with this company, if we look at the chart, they have increased massively over the last few years. In 2019, they were about $60 a share. Now we're $199 a share. But this is justified. They have been performing very well like these other companies. And I don't think Teledoc is overpriced. They have a market cap of 28 billion. I think this is a drop in the bucket of where it's going to be 10 years out. You look 10 years out, you're going to see this company probably at 200 billion. Going into their financials, price to sales ratio, guys, 17. That is not bad. Not bad for a growth stock like this. I do realize that a year ago it was only 9, but regardless, I think 9 is grossly undervalued for this company. I think 17 is getting closer to where there should be. But if we look at what analysts are expecting, they're expecting 81% growth next year. I'm sorry, but 81% growth and a price to sale of, what did I say, 17? Yeah, 17. Yeah, guys, that's crazy. I think this company is undervalued. I mean, I realize they've appreciated massively over this last couple of years. I think that's just because they were grossly undervalued and there wasn't a huge need for telehealth prior to this health crisis. But innovation thrives in crisis, and this is an innovative company that has taken full advantage of this crisis, and I think they've solidified their position in the future. If we see 81% growth, oh my goodness, this company is massively undervalued at this point. Right now, analysts have an average price target of 243, and the current price is 199. So even they think it should be higher. I think this should be 300, at least 300. So this is probably the best buying opportunity out of these 5 stocks right now, I would say. Teledoc is undervalued, guys. 17 price to sales ratio. They're expecting 81% growth. I do realize there's a lot more you need to look at, but this is a dominant player in this industry. This is an industry that's going to grow at a very high growth rate. Make sure you do all your own research before jumping in any of these stocks. But the top 3 stocks out of the 5-day list, MercadoLibre, Teledoc Health, and the Trade Desk. Those 3 picks I think are all very good picks right now. Just expect some short-term down pressure potentially in January. I'm feeling a bit bearish about January. I've heard some other Wall Street analysts talk about January being a bad month, and I'm getting those feelings just because this massive rise we've seen over the last few months. Anyways, though, it's just a feeling. You never know what could happen. But yeah, guys, make sure you add these 3 stocks to your watch list. Really consider Teledoc, though. MercadoLibre and Teledoc, I'm probably both going to initiate positions in very soon. Super excited about both of these companies. But anyways, that's all I have for this video. If you guys liked it and appreciate it, make sure you drop it a big thumbs up. And as always, subscribe to this channel if you want to see more content like this. And thanks for watching until then, guys. I'll see you on the next video.